a lot of stuff going on. We got inflation reports here and over in Europe. Also a central bank decision over in Europe. Just a lot of things going on. A big earnings report from NVIDIA. So with all this going on, you actually raised your S&P price target to 5,500. You also have a Goldilocks number of 5,700. What are you seeing right now? Because it seems like there's a lot of potential for volatility.
Yeah, look, all great points. I think that this is really a time to take a little bit of a step back as we enter the summer and look at some of the bigger trends. So we've already seen some central banks cut interest rates around the world. We've seen inflation falling around the world. We've seen the AI CapEx spend increasing. We've seen the real strength there. And we've seen this equity rally broadening out, not just in the United States, but also globally. So we think that's a pretty benign backdrop right now, both for stocks and for bonds.
All right, so benign backdrop. That's what you're seeing. I want to also show you something, and I want you to listen to something. Minneapolis Fed President Neel Kashkari was on CNBC earlier today. We're going to play the soundbite. You let me know whether you think this is hawkish or not. We're going to play right here.
The U.S. economy has remained remarkably resilient. GDP growth has been strong, much stronger than forecast. Most people thought that we'd be in a recession toward the end of last year. That didn't happen. Instead, we had very strong growth. U.S. consumers have remained remarkably resilient. The housing market has remained resilient. So I'm not seeing the need to hurry and do rate cuts. I think we should take our time and get it right.
Yeah, I was listening to what he was saying. So he didn't say they're off the table. He didn't say let's push them back, but he just said no hurry. Right now, as we mentioned earlier, futures are in the green. How do you think those comments impact the market? Also want to get your take.
Well, I think that's bullish for him taking a nice summer break. I mean, we think that the rate cuts are going to start in September. We think 2 this year. So not necessarily out of line. The Fed, that was a little bit of a victory lap, saying things are on track. We can afford to take our time.
So do you think that's a change in what he was saying before? Or do you think he's just staying consistent? Because we keep, he's a voting member, by the way, but we keep kind of hanging on every single word. Did you see any change in his commentary, or does that seem consistent to you?
I think that the broader message of, being data dependent and kind of looking at the broader picture, that still remains constant, as does a lot of commentary by various Fed members kind of in between the meetings.
All right. So I want to get back to what you're seeing again. So despite record highs, the investor money on the sidelines and money market, it just continues to grow. So over the last 2 weeks alone, it's grown by $30 billion. And recently, you put out some of your targets for GDP, inflation, and also the 10-year. So you see the 10-year falling, inflation remaining pretty sticky, and then growth at the same level as last year. So you tell me, in this kind of environment, as we look at the last month of the first half of the year, the last week of this month, where do you put money to work, and why do you think so many people want to stay on the sidelines?
Well, I think that, currently we have great yields in things like the money markets. But as those numbers show, and we've been telling clients, that's probably not going to last. And as rates do start to fall, this money that's in money markets is going to seek other homes. And we think some of that is certainly going to go into fixed income. And so that's why we're telling clients, now's the time to maybe lock in some of these longer term yields before those money market rates start to fall.
Right. So fixed income is your top pick. But when are we talking 10-year, 20-year, 30-year? If you want to lock it in, how long do you want to lock it in for?
I mean, I think we take something of a barbell approach. We like very high quality credits, but the 5-year kind of investment grade, we like that. And then also, looking at some things in alternatives, private credit, things like that, makes sense for some investors.